The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Weak economic data, mixed corporate earnings, bringing the S&P's six-day win streak to an end. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. And it's the end of April. We can get wrapped up for those soups, too, which should be really fun.
Soups as in?
Superlatives.
Oh, I thought you meant like...
Not soup. Superlatives. And speaking of, you're looking at an S&P now down 3 straight months. We haven't seen that since October of 2023, and today's continuing that trend with the S&P off by 0.8%. The Nasdaq 100 also off by a similar amount. But it really still is off the lows of the session. Romaine, at one point it looked like we were going to see a serious sell-off underway, but the personal consumption as well as income helped to support the overall markets. 10-year yield going nowhere, but it did go a lot this month. It's down for 4 straight months now. Quite a losing streak in terms of the yield. And NYMEX crude oil off by a whopping 4%. The energy stocks getting hit really hard, Romaine.
I was then thinking about sort of the shift in sentiment that we had at the start of trading, and you really have to go back to last night when Supermicro released preliminary look at its quarterly earnings report. It was basically sales projections for the server maker that were going to come in about 15% below what the street was looking for. And that dented whatever was left of any sort of tech trade enthusiasm. Then you had the new DeepSeek report of a new AI model. That didn't help matters either. But we'll see if that tone shifts after the bell. We do have earnings from some of the big heavyweights, including Meta, including Microsoft, and we'll throw Qualcomm in there as well. But even if those earnings are good, the question is, will that be good enough to overcome some of the concerns about the economy? We did get fresh data today, as Alex was referring to, on consumer spending. That surged last month. But at least half that upside surprise in consumption actually came from panic buying ahead of tariffs. Complicating matters was a first quarter GDP report that reflected economic activity before most of those tariffs were even announced. That report showed contraction for the first time since 2022. So that has investors looking, well, around the corner to next week's Fed meeting for a potential yet unlikely lifeline as the S&P logs its first loss in days, eroding what had been an actually pretty stunning rebound rally. And that's now capping, as you just pointed out, Alex, a third straight month of losses now. That has erased something like $5 trillion from the benchmark index markets value.
And raises the question, what actually provides support? This is a great chart that comes to us from Citi that takes a look at how stocks trade after their earnings day. And it does show that we're seeing about 60% of stocks that beat actually move higher, which is a pretty significant amount, nowhere near what we saw in 2023 and 2024. So you might think, hey, that's pretty good. You beat, you have a good earnings day, and your stock has a good day. Citi goes on to say, though, they think that's actually more positioning than fundamental because the markets were really short going into earnings for particular names. And guess what, Romaine? Names like Microsoft are those that have been particularly shorted, which means are we going to see a snapback if there is a good, solid number? But it's not truly fundamental, right? It's not really that long fundamental buying, Romaine.
It's kind of interesting, too, why the short interest rises. You've seen a lot of investors move to the sideline, at least based on options activity right now. You're actually looking at predictions for some of the narrowest moves up or down in some of those names, depending on what we learn when they report those earnings. Sylvia Jablonski joins us right now. She's the CEO and CIO at Defiance ETFs, here to kick us off to the close. Sylvia, great to see you. I do wonder about the leadership of this market and whether we should be looking to Microsoft's Meta, basically the Mag 7 big tech, if you will.
Well, thanks for having me, Romaine. I think that we hope to look for the Mag 7 in terms of leadership, but we just haven't seen it in a while. And that's also kind of normal. You know, I think some of the higher growth stocks tend to suffer the most when you have an impact to the market like we did with tariffs. And so some of them are 20, 30, 40% off of their all-time highs. But I think what is kind of good is that this feels more like a correction than it does a recession because it has bounced back. Although it's another negative month or it's looking like one anyway, we did have a nice rebound. We did have breadth there. And I think as long as these names kind of hold up with earnings, that's enough for the market. So expectations are low. If it's kind of benign with foggy outlook, I think that's probably not going to be too bad for the markets.
With regards to the outlook, what do you think is worse? Or maybe let me flip that around. What do you think would be more palatable to investors? Just pulling the guidance all together and just saying, look, we just don't know enough, so we're not going to give it to you. Or just kind of standing pat, saying, look, we gave you something before. It might change in the future, but right now we're not going to do anything.
Yeah, I think having a solid report is kind of step one, and step two can be vague. You were talking about it before. I think the fundamentals are foggy. We just don't have the information to kind of project into the future. But the macro is a little bit clear right now in terms of tariffs could be a potential problem for the markets. If that doesn't get resolved, we're going to have this continued volatility and a pullback. If it does get resolved, we probably will have a correction to the positive. So that's really what's going to matter. It's all about tariffs. I think it kind of doesn't matter what they say. They have a pass not to say much, but good reports are better than bad ones.
Totally, yes. It sets you up at a better base. I was mentioning how Deutsche Bank pointed out that Google, Microsoft, and Amazon are one of the most shorted stocks. Do you like the Mag 7 here?
I do like the Mag 7, but I think it depends on your perspective. If you're highly allocated to the Mag 7, then what I would do is look at the S&P 500 minus the Magnificent 7. You can use an ETF for that, so you get broader based exposure for the names that are just not performing right now. If you don't have exposure, though, those names are on sale. You had a lot of retail investors coming into NVIDIA in the 140 range, and down at 98, there wasn't so much buying. It did come back eventually, but we're still kind of, not doing much there. So if you look at the Mag 7 and you're not allocated, pick some of that up. It's the future of AI and quantum computing. If you're not, look to broaden out to the rest of the S&P 500.
So to that point, would you consider growth still defensive at this point, or is it not that easy?
I think that, the top names participate in both disruptive innovation and growth, and they're also quality. So for example, names like Microsoft and Google, they're major players in quantum computing and in AI, and that's a growing theme. We're projecting trillions of dollars of growth in that in the next half decade to a decade, but they're also a ballast because they have strong balance sheets, they do buybacks, they pay dividends, and they're quality companies. So, I'm never going to feel bad about holding those stocks in my portfolio.
How do you sort of protect yourself if you need to or you feel the need to? Do you think the best way to hedge or at least provide some insurance to your portfolio is still through the options market?
I think, so again, I think it would be allocating outside of the Magnificent 7, just because when you have volatility, that suffers the most. And I'll give you a controversial answer. People love gold and people love crypto, right? And a lot of times crypto has been correlated, a lot of times it hasn't. But there's a stock that's up about as much as gold is this year, and it's MicroStrategy. That's a crypto play. It's a Bitcoin play.
Yeah.
So it's a way to get exposure to something else in your portfolio.
It's interesting you say that. Is there not maybe an argument to be made that you should be directly into Bitcoin, meaning instead of using a proxy like MicroStrategy or even using an ETF to get access, that maybe the insurance is from actually being an actual holder?
Yeah, and I think that a lot of people view it that way, but if you just look at the performance, just compare actually MicroStrategy to Bitcoin, and it's usually like 6 to 7x the performance of Bitcoin. It's just when it rallies. It's on the other side, you also get the drawdowns, right? So, kind of depends on what you're looking for, but it's a listed stock. I think it's a little bit more comfortable for some advisors to put that in a portfolio than it is crypto, but I think both are good diversification tools.
So a bit of a kind of a leverage play to a certain extent versus just holding the asset itself.
Absolutely right. Yeah. Absolutely right.
America still wins here?
America still wins. I mean, I think, that Sell America trade felt like it was hot and going on. But when you look across the globe, we have the highest participation in any global market by retail investors. That's number one. Number two, we still have the best, highest quality companies where you can have a scalable investment deployed in the market. So America still wins. All
right. Sylvia Jablonski also wins for us, kicking us off to the close here on this Wednesday afternoon. The CEO and CIO over at Defiance ETFs. When we come back, we're going to check the temperature of the energy sector with two CEOs in that space. Mark Lashier over at Phillips 66 and Pedro Pizarro of Edison International.
Plus a temperature check on the economy after that latest GDP print with Justin Wolfers, University of Michigan professor of economics and public policy.
And we promised you some big tech earnings, and we're going to give them to you. Full coverage, extensive coverage like no other, right here on Bloomberg after the bell. Meta, Microsoft, Qualcomm, and everything in between. Stick with us. This is The Close on Bloomberg.
Shares of Edison International are down almost 10% on the day, despite the fact the company reported results yesterday, reaffirming its core earnings per year forecast for 2025. Now, the issue, of course, is the Los Angeles wildfires, which obviously came up on the conference call. CEO Pedro Pizarro said as the investigation continues that Edison is working closely with state and county leaders and communities to rebuild wildfire-impacted areas and build them back stronger. Pedro, the CEO, joins us now. At heart of this is whether a power line that was retired decades ago by Edison International caused or led to these fires. It's so hard to determine how much this will cost. What do you need to see to finally have some kind of clarity into the range of liabilities you're dealing with?
Well, first, Alex Romaine, thanks for having me on, and our focus continues to be on helping our communities rebuild. To your question, these investigations can take quite some time, and we would expect that the official investigation by fire authorities could take 12 to 18 months. What do we need to see? Well, we have seen a number of pieces of what I would call circumstantial information, but we have not seen some of the telltale marks that you often see with this kind of discharge. And so our investigation will continue. We're in the process of taking the lines down right now. We expect to send that equipment to a lab. We're doing this in concert with a number of stakeholders, including the attorneys for plaintiffs, so that there's common understanding here.
Pedro, California has a $21 billion wildfire fund. Credit Site said today that if you guys need to tap into it, it could wipe out that fund. When would you need to draw on something like that, looking at your balance sheet and your revenue?
All right. Well, with the structure that California has, that's one of the benefits here in the state. We have a framework that provides a wildfire fund, along with other elements like clarity in terms of the obligations for utilities with wildfire mitigation plans and expecting us to be prudent but not perfect. The drawdowns of that would be as we go along. So if we end up concluding that this fire was caused by Edison equipment, we would engage with plaintiffs. We would start doing settlements as we've done with other fires. The first $1 billion of exposure will be covered by our standard insurance. And today it's customer funded self-insurance. As we go beyond that $1 billion, we do have that $21 billion fund there. And that would probably mean drawdowns over some number of years. But importantly for investors to understand, as we pay out settlements, if we end up doing that, we then get immediate reimbursement from the fund. So we would not expect any impact on our balance sheet or our credit metrics as we do that.
I am curious, Pedro, about some of the relief or potential relief measures, if you will, or just some of the changes that could be made to some of the provisions out there in the state of California. Do you still anticipate that the legislation that is being pushed will be passed and will be passed sometime over the next few months?
Well, it's early days, but we are very comforted by the degree of focus that we see on the part of the governor's office and legislative leaders. And look, Romaine, even if Eaton ends up not being associated with Southern California Edison, which we think now may be probable, but even if it weren't, these massive fires, the Palisades and the Eaton fires together, same time, same area, same windstorm, same climate conditions, have sent a signal to the market, right, that the largest exposure here may be larger than any of us imagined in 2019 when the law was passed. I think legislators understand that and therefore are focused on extending the framework so that it can be more durable. But, lots of work ahead on that, and still early days.
Does the timing, though, of it matter in relation to the actual investigation of the cause of the Eaton fires? Meaning, if you do get a decision on one, particularly on the Eaton fires, before that legislation, does that have an impact?
Yeah, I don't think so, and it shouldn't. These are separate tracks. On the one hand, you have the investigation on the fire, and we sought to be totally transparent. If we find the conclusive evidence, we will be the first to say that. But on the other hand, you have the focus on the state's framework, and look at how it hasn't only been Edison stock that has been impacted, but look at PCG, Pacific Gas and Electric, our peers in the north. They have no nexus whatsoever to the LA fires, yet they have also experienced a significant valuation discount. And so This is a matter of the state understanding the need to have financially healthy utilities so that we can power the other 95% of the economy and so we can help the state advance its clean energy goals.
And a big part of that is also data center loads as well. And you guys have to spend CapEx in order to meet the strong demand. Does the Eaton wildfire sort of eat into your ability to do that, or do you feel like you can continue with your CapEx and OpEx plans?
Yeah, Eaton does not into that. We absolutely can continue. Today, we're investing, or over the next few years, we're in the range of $6 to $8 billion a year of capital investment, pending a general rate case decision. And so, again, one of the benefits of the wildfire framework we have here is that because we can access the wildfire fund, an exposure like that should not impact our metrics, and we can continue to make the investments that our customers need us to make.
Pedro, really appreciate you taking time for us. Pedro Pizarro is the CEO of Edison International. When we come back, we're going to stick with this conversation about energy, but do it through the lens of, well, gasoline. Mark Lashier is the chairman and CEO of Phillips 66, the biggest U.S. fuel maker by market value. A discussion on their trade war outlook and their proxy fight with Elliott Investment. That's coming up next on The Close on Bloomberg. All right, just a little while ago, we caught up with Mark Lashier, chairman and CEO of Phillips 66, about how the U.S. fuel maker is navigating economic conditions and, well, of course, dealing with that proxy fight with Elliott Investment Management, including what they need to do to actually satisfy some of those shareholders who actually agree with some of Elliott's points. Here's what he had to say.
We've been on about a 3-year journey, improving our performance, delivering on commitments to shareholders. Since mid-2022, when I became CEO, we've delivered 67% total shareholder return, and we've lowered our refining costs by more than $1 a barrel. We've got higher rates of crude oil going through our refineries, and we're making more valuable products with that crude oil. But we've got more work to do. We're the first ones to admit that we've got more work to do. We are leaning hard into our integration between our midstream, our refining business, and even into Chevron Phillips chemicals business. And we believe that's our competitive edge, that when we leverage the refining assets with our midstream assets and the petrochemical assets, over the long term, we deliver a higher return on capital employed than a portfolio of companies that would look like us. And that's the ultimate measure of value creation.
So how do you do that with those three assets? How do you become offensive versus defensive?
We become offensive by taking full advantage of the assets we have, getting the most throughput, the highest yields, and then trading around those assets, optimizing those assets every single day, using the information that we have access to move into the marketplace where we need to move in to create the greatest value faster than our competitors.
One of the criticisms that we've heard from Elliott, and I'm sure you've heard it as well, not just from them but from others, is also about the talent within your walls and whether that's enough to actually get you to some of those long-term targets.
We're always looking at our talent, assessing our talent, upgrading our talent. We haven't been shy about reaching on the outside to bring in talent to supplement. My executive leadership team, there are five executives of the 8 executives on my leadership team came from outside the company, but we're also working hard to develop talent inside the company. We've got a talent program. We've got a cooperative agreement with Rice University where we're taking our best and brightest and making future leaders out of them.
So specifically, one of their pointed comments was also about the trading business, the improvements they want to see there, and whether you have the capability to actually make those changes, at least at the pace that they want them made.
We've recruited some outstanding talent into our trading business. We've been fending off other large integrated oil companies that are jealously looking at the talent that we have in our trading business. So I think we're on the right track with respect to our trading business. They're doing an incredible job creating a lot of value around our assets.
The other part, of course, has been the midstream business, unlocking value, spinning that off or selling it, et cetera. Elliott came out with its own deck about certain companies that might want to buy it, like Williams, ONEOK, Energy Transfers, MPLX, et cetera. Has anyone been calling you, or have you been calling anyone on this news?
That's a great question. Investors have asked us the same thing. Nobody's been calling us up saying, hey, we're ready to do a deal. I think that there's a lot of challenges around the math that's being used to describe describe what we could create and the value we could capture from selling or spinning off our midstream business. It is so deeply integrated with what we do, particularly around our Sweeney asset, where we've got a 260,000 barrel a day refinery integrated with Chevron Phillips chemical assets. We've got midstream fractionators, all these pipelines coming together that are deeply, deeply integrated, and we can optimize around that and beat the competition every day. To rip that apart and to sell it off would be value destructive, and those that have sat down and looked at the math agree with us.
Okay, so no talks.
No talks?
Yeah, with some of your competitors about that asset.
Absolutely not.
Okay.
No, nobody's called up about buying our assets, and we think that those assets are so valuable that it would be difficult for any competitor to come up with cash to meet our expectations.
I want to get your thoughts, Mark, on what's been going on economically speaking, particularly with regards to the summer driving season coming upon us, and of course that the backdrop being economic conditions that, at least from what we know now, could be materially different than what they were last summer or the summer before here.
Yes. Now, look, we are prepared to deal with whatever economic conditions come our way. There is a lot of volatility in the system right now, but we're absolutely prepared to deal with it. That's one of the beauties of our integrated business, is it allows us to thrive across the economic cycles.
Are you anticipating there's going to be any significant change in your performance this summer, over these summer months?
Well, I think we continually try to upgrade and improve our performance. We don't control margins, but we do our best to capture whatever margins are out there and deliver the best value we can for our shareholders.
The margins have been really good. Do they normalize at some point?
Margins have been improving. They were pretty tough in the fourth quarter last year, first quarter this year. They're starting to improve, and economic volatility is not good for fuel margins. But we'll see how people want to travel this summer, what they want to do. We actually saw an increase in refining margins the last time there were economic challenges, because people were out driving more, because that is a pretty low-cost way to entertain the kids.
That was Mark Lashier joining us, Chairman and CEO of Phillips 66. We also went on to talk to him about the administration and permitting. Yeah. Right, he's midstream, so you want to put some shovels in the ground and stuff. Secretary of the Interior, Doug Berman, has talked about really moving those times in order for permitting down to like 14 days, 28 days if you count environmental permits. And he's like, I don't think that's going to work.
Yeah, but that's what I don't get. Why not?
I think because he was, well, from what Mark was saying is that you need clarity over the longer term, and being able to lower permits through like an executive order or something short term is only 3 years now. And what if the next administration comes in and changes stuff? You need much more clarity when you're putting billions of dollars in the ground that can take much longer to actually build.
Clarity, a key word that we've heard a lot over the last few weeks.
All right, coming up, we're going to break down that fresh GDP and PCE data with Justin Wolfe, University of Michigan professor of economics and public policy. I'm taking a look at the markets here. And again, we are well off the lows of the session. We're still down for about 0.8% on the S&P. The NASDAQ is off by a full percentage point. And just for your superlatives here, S&P down 3 straight months from me. We have not seen this since October of 2023. The dollar also down for 4 months. We haven't seen that since January of 2023. Gold up, oil down. You getting the theme here?
I'm getting the theme here.
Getting the theme.
We got a slew of corporate earnings on tap over the next couple of days. Stick with us. A lot more coverage coming up here on the close. This is Bloomberg. .3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. So let's get checking on the markets. Of course, we're at the lows of the session. Nonetheless, it's a rough way to end the month here.
Yeah, absolutely. I mean, we talk about a market that had really staged a pretty healthy rebound. It was up for 6 straight days, but really you kind of take the differential from where this market was prior to Liberation Day at the start of the month and where it looked like it was going to end. And of course, losing some steam here, 3 straight months of losses. And the question is, what's driving that? Is it about tariffs specifically? Is it about corporate fundamentals? Is it about economic conditions, or some amalgamation of it all?
And the soft and hard data, right? Soft data has been terrible. Hard data, though, is relatively holding in. Just look at the GDP print for the first quarter today. We know that imports shaved off 5 percentage points, but without the U.S. trade, the economy grew at the fastest pace since 2021. For more, we're joined by Justin Wolfe, University of Michigan professor of economics and public policy. Can we back out those imports numbers and just look at the real growth of the economy, and is it really not that bad?
So it's funny, obviously the headline, shrinking GDP, looks terrible. And then everyone's second favourite indicator, which Jason Furman has been calling core GDP, rose at an annualised rate of 3%. That looks wonderful. And then you go one level deeper and look at what was driving that. So that's about consumption and investment. And the problem is that there's no part of the American economy through March that wasn't distorted by talk about taxes. So very sharp rise in investment. A huge part of that, though, is a rise in business inventories. Beyond that, if you look at the business investment, and the other big contributor is equipment. And a lot of our business equipment we import from China. And so very likely that was folks moving April and May's spending back into March. So that's not real either. And then what's left is consumption. And yeah, consumers knew that tariffs were coming. And so they were shifting some of their consumption forward. At the end of all of that, so you don't believe the pessimistic view of minus 0.3 and you don't believe the optimistic view coming out of core GDP. I think you're just left with two big conclusions. One is these are not very informative data. And the second is this is very much still looking in the rearview mirror because this is telling us about where the economy was January through March and Liberation Day was April 2. And if you were listening at all, you could hear a crack in the economy on April 2. And we haven't yet seen any of the hard data of where that, how big of an effect that's having.
Yeah, we were definitely listening, but we have seen the soft data, which goes to the point of when do you expect then to see the hard data catch up with the soft data if it does?
Well, we have to wait for some numbers that are for about April. I mean, Liberation Day wasn't until April 2, so nothing's overdue yet. We're just a little bit impatient. So nothing could have gone particularly wrong. Some things went wrong before April 2. Many of us are worried a lot more went wrong after April 2. How quickly that filters through to the economy remains very much an open question, but the earliest we could see it is when we start getting hard data for April, which we're still some distance away from. So it's the fact that it hasn't occurred yet has got only reflects the delays in publishing federal statistics.
Well, and when we talk about just the cracks, and I understand that all of this, the data we're looking at is backwards looking, and of course it doesn't encompass the more reality of what we learned on April 2nd. But we kind of had a sense of what that reality was going to be, not necessarily the magnitude. And I bring that up, Justin, because we got economic data out of other countries as well. Canada missed on its forecast for GDP growth. You're still seeing pain and contraction in the Chinese economic data. Their PMI data just released. And then you had that relatively surprising, I guess, if you will, upswing in economic activity in Europe. This isn't all just coincidental, is it?
Well, it's not just coincidental, but equally it's not as simple as any of us could possibly interpret. The problem with tariffs and people wanting to front-run tariffs is it drives a wedge between what we're consuming or what we're buying and what we're producing, right? So we're buying a bunch of stuff from overseas, but we're not making it.
Yeah.
Usually, estimates of what we're buying are pretty related to estimates of what we're producing, so that's why we rely on so many spending-based statistics. Right now, we know there's a massive wedge, which means that spending-based statistics don't tell you what you normally would hope they tell you. And that's a problem not just for the United States, but it's also a problem for these other countries where what they've been doing is producing, because they've been loading up the ships. They've been producing but not spending. So it is going to be ridiculously difficult to read the data from basically 8:28 a.m. this morning for the next 6 months, because even next quarter is not going to be the pure effect, because what the front running did is a bunch of spending that would have happened in April happened in March.
Right. And we also know that we could actually see a little bit more of an upswing in the next report, primarily because some of these distortions. That doesn't necessarily mean things are great. But it gets us back to this question of, and you're the economist who has to go to look a little bit further out to try to determine what economic conditions will be. When you look at the totality of what's transpired over the last 100 days, including Liberation Day here, do you anticipate a real recession, a hard recession? I'm not talking about where we're backing out this number or backing out that number or doing this or doing that. I'm talking about the official definition by NBER. We're going to see a recession or not.
Yeah, so there's no one answer because it depends on what the White House does. But I'm not trying to duck the question. So let me take you seriously. If we continue full steam ahead with the full set of shocks that we have right now, and I think there's three things going on. There's a huge tariff shock to deal with. There's a massive uncertainty shock, which is going to cause a pullback in spending. And then there's a confidence in the competence of the US administration, which we're seeing in bond markets and currency markets and so on. If we continue with the full Trump, I'm going to guess there's a 75% chance of a recession in 2025. If he were to pack up tomorrow and go home and say, my bad, didn't mean it, I'm going to call some economic advisors and take their advice. I'm not saying everything's going to be great, but I think those odds come all the way back down to 25%. Where are we going to end up? Well, we're probably going to end up somewhere in the middle, right? So he went the full Trump and then he started to back down. Mm-hmm. Is he going to keep backing down? If we end up somewhere in the middle, the odds are somewhere in the middle. So you've heard my pessimistic take, and it's totally serious. You don't hit a macro economy that you want to succeed with chaos and adverse policy like this. Here's the optimistic take. The economy usually just keeps on keeping on. It's like a cruise liner, and I don't mean the Titanic. Once it gets momentum, it keeps going, and there's thousands of people at work on that cruise liner just doing their thing.
Yeah.
You and I are worried about the subset of those people who are exposed to global trade, and they are freaking out. The question is everyone else on the ship just going about their business? Can they be unaffected by whatever waves hit the cruise liner and hit the parts of the economy that are exposed to trade?
I think we're going to find out, I guess, in real time over the next few weeks and months. Justin, really appreciate it. Justin Wolford's one of the brightest minds in economics, University of Michigan professor of economics and public policy. When we come back, we're going to push ahead to those earnings after the bell, including a deeper dive into Robinhood. This is Bloomberg. Time now for our top calls. Big movers on the back of analyst recommendations. And we start off with Ford. Wolfe Research increasing their rating to peer perform from underperform. This in the wake of President Trump signing 2 orders to ease the impact of auto tariffs. The analyst now saying that new development could give Ford a competitive edge. The share is down 2%. Nevertheless, up next, First Solar. KeyBank downgraded to underweight. This after the solar module company cut earnings guidance for the year because of tariffs. Now, the analyst citing those tariffs as well as economic risks, regulatory changes, and other, quote, painful headwinds, says First Solar is vulnerable to further margin compression. Those shares down 9% off the lows of the day, but still having one of its worst days in months. And finally, let's take a look at Nike. Wells Fargo downgrading to equal weight, trimming the price target to 55 from 75 bucks. And saying, well, Nike was actually among 7 changes to apparel recommendations by Wells, which included downgrades to Carter's and Gap and upgrades for Levi Strauss and Ralph Lauren. Nike shares down 2.5% on the day. We are focused here on earnings on this Wednesday afternoon. Robinhood set to report after the bell. The financial services platform is expected to post revenue growth of about 49% year over year. That would actually be a slowdown in growth. Pleased to say we're joined right now by one of the analysts who covers this stock. John Todaro is senior analyst and managing director over at Needham and Company. All right, John, what do you expect to hear tonight?
Yeah, so the Q1 should be a decent quarter. You should actually see a little bit of growth quarter over quarter in equities and options. Where you're going to see slowdown is in that crypto segment. We're estimating about a 30% lower crypto volume in Q1 versus the prior quarter. You are coming off very high crypto activity. So the next thing everyone's going to be looking at isn't so much Q1, but April, where we are so far. How are crypto volumes faring in this month? Any tariff impact to market business on the equity side? Are we seeing retail investors pull back some there? And then the last piece I think a lot of investors are going to be focused on or should be focused on is the prediction market platform. So they rolled that out in Q1. This is the first time we're hearing kind of how that business has gone.
In terms of the active user growth in general, what are you expecting there?
I'll have to pull that up. I don't.
That's okay. Do you expect it to be better? Do you expect it to disappoint? I mean, just to give us some rough estimates.
Yeah, I think you're going to continue to see user growth, but it should be moderating here. So a lot of that activity into Q4 was very strong. From here, in terms of our active users and that growth there, it should be moderating. And you're gonna see it in almost all the transactional segments, as I mentioned. So equities and options should be about flat, maybe a little bit growth there. And then crypto should actually pull back some. If that bleeds into users kind of pulling back noticeably, I think in crypto you are going to see some of that. Equities and options, I would think you're going to have a little bit of growth there still.
I am curious long term, John, as to where you see this company going. I think over the last couple of quarters, I mean, there's been a lot of talk about new products, new lines of businesses, basically ways to diversify this company and quite frankly, make it a little bit more of a traditional finance company. I know they would bristle at that characterization, but I think investors want to see that. Do you think they're going to articulate some sort of plan?
100%. Yeah. We saw at their gold event in San Francisco, they rolled out a lot of banking products. There was obviously going to be a push into wealth management, so they're going to talk more about that. There's a couple more events coming up. One's focused around crypto, so we would expect them to make a bigger push into crypto, especially with deregulation on the horizon here in the U.S. So I do think that the goal is very much to diversify the product offering. They've done a very good job of that so far, and I think that's going to be the stated goal to continue. To push more into the banking products, push more into prediction market platforms, to do more event-based contracts. They are very broadly going after a number of areas.
All right, John, thanks a lot. We really appreciate it. Looking forward to getting those numbers in about 15 minutes time. John Todaro, Senior Analyst and Managing Director at Needham and Company. All right, coming up 15 minutes away from the closing bell, we're going to take you to them with Megan Horniman, a Chief Investment Officer at Verdence Capital Advisors. Plus, we are waiting for Meta and from Microsoft and Qualcomm, Robinhood, and a bunch of other names.
It's imminent, Alex.
It's imminent. It's getting so pumped. Second busiest earnings day. This is Bloomberg.
All right, stocks well off the lows of the session, Alex, as we head into what is going to be a really busy afternoon after the bell tonight. At least about 20-something large-cap companies are scheduled to report earnings, and that includes two of the biggest companies by market weighting, and that's Microsoft and Meta.
I was going to say, it's going to be magnificent. Did you get it? Mag 7. Mag 7 trading a little heavy, though, as we go into the close. I was pointing out earlier that Deutsche Bank was saying that you had Google, Amazon, and Microsoft were the most shorted among big-cap tech. So you wonder how that market reaction will also change. But I also want to point out here that we're still, it's a safety trade today, you know, like consumer staples, healthcare, really outperforming on the S&P.
Yeah, and I think that some of this has to do with kind of the yin-yang between obviously still concerns about policy, but then you had the economic data this morning, which was really kind of a hodgepodge, right? I mean, you had the ADP data, which continued to show softness in the labor market. You had a PCE report, though, that seemed to show resiliency in consumer spending, inflation relatively under control, but then you had a quarterly GDP report that seemed to just kind of throw water on all of it.
Yeah, you guys confused? I mean, yes, because everyone should be, yes. And then we go into Jobs Friday, and how much will that actually, I think the survey data took place at the week that all the tumult was happening. So you wonder how volatile that's going to be. Yeah,
so maybe some potential insights there as we continue to count you down to the closing bells. We are just about 8 minutes away from that, and also 8 minutes away from those big earnings. Let's bring Megan Horniman into the conversation. She's Chief Investment Officer over at Verdence Capital Advisors. All right, Megan, I want to start with economic conditions first, because there's been a lot of talk about these data points that we got today. I know it's a lot of noise, a lot of distortions, if you will, that will have to be sorted out over the next few months and quarters. But based on your read right now, from the view as a Wall Street investor, are you at least somewhat confident that economic conditions will hold up enough to support valuations?
I think that we're finally starting to see some of the, I guess you could say, hard data come out that's reflecting the policy uncertainty, whether it's the tariffs, where we saw the big increase in imports in that GDP number, but also with a slowdown in personal consumption in the report as well. So we're starting to see some of the policy lead into this data, and I don't think it's over. I think that this is just the beginning. We're going to see this filter into not only inflation, but also whether it's, don't forget, we'll get manufacturing tomorrow. We'll get the services index. We'll also get, as you mentioned, the employment report on Friday. So just be prepared for some more volatility, not necessarily because of tariff headlines, but now because we're starting to see it filter into the data.
How much visibility do you have as a CIO, or do you think you have at least as a CIO right now relative to a year ago or 5 years ago?
It's still very uncertain, especially from not only the government policy, but don't forget the Federal Reserve. That's a big factor here. I think that valuations are expecting that the Federal Reserve will be able to have the flexibility to cut this year. We still think that they will cut, but I don't think they're going to cut at their May meeting. I think it's probably a June or July story because they're also as unclear on not only the policy, but what it means for inflation going forward. So there still is a lot of uncertainty. So in that case, be prepared for the volatility, have some dry powder on the sidelines. That's what we're recommending for our investors.
Megan, do you think that tech earnings can provide some meaningful support to the market?
This earnings season is very interesting because this is so backward looking. And I think that most investors are looking at that. It's what are they giving as far as guidance going forward? And unfortunately, they don't have a lot to offer because they don't know as much as the rest of us what will ultimately happen from the tariff prospect. And then also, what does it mean for inflation? What will the Fed be able to do? So I think you're seeing, these earnings reports, they're moving the market to some degree. I don't think that it's going to create a long-term stability here in the market if we get good results out of some of these tech names. I think it still now all depends on what does this mean from the economic standpoint.
Mm-hmm. Okay, so based on that, we don't know, ... Where's your safe haven while we all figure that out?
Mm-hmm. So the safe haven is know that this is probably most likely a short-term phenomenon. This is where you want to be able to take those opportunities where you see discounts. We haven't seen some of these discounts in whether it's small or mid-cap stocks that we've seen in a very long time. International stocks, even some of the U.S. large cap, we're starting to see some discounts there. But just be gradual because there's going to be more opportunities. So we think from a safe haven, having some cash, there's nothing wrong with that because you're still getting a good yield on the cash, and you also have that dry powder and that opportunity to take advantage of any dislocations in the market that we think we'll continue to see. So we're being defensive, cautiously optimistic, but we're also adding in when we see weakness here in the markets in the equity side.
I am curious, though, too. I mean, when we talk about some of the outperformance that we had seen over the last few weeks of non-U.S. assets relative to U.S. assets, there was a lot of talk that this might be a reallocation or rotation that was going to be more permanent rather than transitory, if you will. Do you see any sort of life, any sort of, argument to be made for a longer duration reallocation to non-U.S. assets?
Yeah, absolutely. We haven't seen, the U.S. has been really the driving force on the global equity market for several years. And we think that specifically the developed international markets, not necessarily the emerging markets yet. We're not ready to touch those. But when you look at the developed international markets, they have lagged for so long. So I'm not talking about the past, 3 or 4 months. I'm talking about years. They've been lagging the U.S. for so long that I think there has been opportunity. And we've taken advantage of that to put some money to work there as well. I think this is more of that reallocation so that you truly get that diversification that so many investors haven't had because they've been chasing the euphoria of the U.S. tech stocks.
But then at the same time, the NASDAQ turns positive. It's now up 0.4, even more than that. You got the NASDAQ S&P up by 0.4%. Whew. Words are hard when you're looking at numbers. Do you miss on upside? If you go elsewhere, clearly there's still that buy the dip mentality.
Yeah, and I don't think you're missing out as long as you have some, you don't ever want to be out of the U.S. equity market. And to be honest, the U.S. equity market is really the tech side. But there is benefit for the long run to look outside of the U.S. Because when you look at valuations relative to the U.S., so historically cheap. That's where, for example, we like to look at the dislocations. And that's a huge dislocation where the international markets have been so far behind and the valuations are so cheap compared to the U.S. that's where you want to take those opportunities to diversify. Yeah. You'll get these spikes, don't get me wrong, in tech. Yeah. They've had such a miserable start to the year, but you also want to have that diversification for the long run.
All right, Megan, got to leave it there. Megan Horneman, Chief Investment Officer at Verdence Capital Advisors. As we count you down to the close, Alex, just about 2.5 minutes to go. And as you pointed out, a big turnaround on the day. We should point out, this is also a big turnaround on the month. We talk about the indices. With those first 6 sessions or so of the month, they were down 11, 12%. A lot of them actually sitting on gains on a month-to-date basis right now.
And the S&P up 0.2, it means 7 straight days of gains. There you go. We finally got that 7 straight days of gains.
We've gotten that all counted out. A full breakdown of all of the market action over those 7 days starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Alex Steele, taking you through the closing bell. A global simulcast starts right now. Scarlett Fu in the TV studio, Tim Stenovic in the radio booth, Carol Massar back in her seat on a very busy day with a slew of big earnings coming after the bell tonight. And look, Carol, this market was actually just puke earlier today, but it's now seen some life as we get closer to those closing bells.
Is that on the CFA exam?
It was page 1073.
A Bloomberg function,
which, believe it or not, is still chapter 1.
Puke.
Okay.
Having said that, fascinating. Tim and I were looking at headlines, trying to figure out why all of a sudden we took a leg to the upside. I mean, we've been in the red all day, and now you've got more names in the S&P 500 because now all of the major equity averages, even if just a little bit, are in the green.
It's interesting. We did see shares of, I should say the index down as much as 2.3%, as high as 0.24%. So a big range today. The real thing that we're concerned about is earnings. We got $6.2 trillion of companies reporting after the bell today.
Yeah, Microsoft and Meta are first up. And of course, tomorrow we got Amazon and Apple. Worth noting here that the NASDAQ 100 is now up 1.6% for the month, and the NASDAQ Composite up 0.9% for the month. So much for April being a horrendous month for these big tech companies.
Yeah, you have to also look at, the last 20 minutes of trading. That's usually going to be fun buying, right? So whether or not that's going to be sustainable longer-term buying, that truly is a question, which then puts the highlight and the onus on these big tech names to deliver.
Absolutely. And we talk about the monthly performance, too. I mean, I know there's been a lot of talk about the wire-to-wire change or lack of, if you will. But, of course, we can't be remiss in not pointing out the volatility in between. Realized volatility still at historical levels, and implied volatility over the next 30 days also well above recent moving averages. Your numbers on the day as we await those earnings. An S&P 500 that's going to close out the day relatively unchanged, up about 0.1%. The Dow up 0.3%. The NASDAQ down 0.1%. And the Russell 2000, Carol Massar, is going to close out the day lower by 0.6%.
All right, guys, we've got earnings out. Qualcomm already crossing the Bloomberg terminal. Let's go to the outlook. Sees third quarter adjusted EPS of 260 to 280 share. The street estimate is for 266 a share. Talking about revenue as well for the third quarter, 9.9 billion to 10.7 billion. The estimate is 10.33 billion. Stock right now unchanged in the after hour. Let's go back to the second quarter, the quarter that was second quarter adjusted EPS, 285 a share. That's 4 pennies better than what the street was expecting, and second quarter adjusted revenue also coming in better than expected, 10.84 billion versus 10.64 billion, the estimate. But I think investors kind of a middle ground in terms of the outlook here, Scarlett, so maybe not necessarily loving it.
All right, some commentary too from the CEO, Cristiano Amon, saying as we navigate the current macro and trade environment, we remain focused on the critical factors that we can control, our leading technology roadmap, best-in-class product portfolio, strong customer relationships, and operational efficiencies. We're hearing that a lot from all these CEOs about managing what they can control. That's usually costs.
As a reminder, Qualcomm gets about 22% of its revenue from Apple, about 19% of its revenue from Samsung, about 12% of its revenue from Xiaomi. So sort of a good barometer when we think about the health of the consumer tech space, specifically when it comes to smartphones.
Yeah, and then to that point, let's take a look at that handset revenue, for example, coming in at $6.93 billion, up 12%. So clearly handset read-through, not so terrible.
Microsoft numbers now crossing the wire here. The revenue number does look like a beat. This for their fiscal third quarter, $70 billion, $70.1 billion if we're rounding up. The street on average was looking for about $68.5 billion here. I'm still looking for some of the other numbers here, but at least a beat on the top line. I need a few more minutes here to dive into the release.
Yeah, it's just crossing, but let's point out to everybody as Microsoft continues to pour across the Bloomberg terminal, we've got the stock up about 6.5%. It was down about 6% year to date coming into these earnings, but Scarlett definitely seeing a top here in the aftermarket.
Yeah, this is a stock that's been down about 6.5% so far this year. And since its last earnings report, also down 11%.
All right, here we go. So operating income does look like it beat up about 16% in the most recent quarter, up to $32 billion. Net income, the bottom line, up 18% to $25.8 billion. On an EPS basis, there does also appear to be a beat based on the average of Bloomberg estimates. The company says that with its Azure unit, this is basically the cloud computing unit, up 33% on a year-over-year basis. The street was looking for growth of about 31%. Its commercial products and cloud services revenue increased 11% in the quarter, and its consumer products were up about 10%. LinkedIn up 7%, and the dynamic products and cloud business, when you combine those up about 11%. Remember, this is on the revenue side here. So it does look like some pretty healthy beats all around, and you're seeing the shares drift higher in the after-hour session.
Yeah, Satya Nadella saying that, quote, cloud and AI are the essential inputs for every business to expand output, reduce costs, and accelerate growth. From AI infra and platforms to apps, we are innovating across the stack to deliver for our customers. Everyone's going to want to know the outlook here. The company says it will provide forward-looking guidance in connection with this quarterly earnings announcement on its conference call and webcast. We will bring those numbers to you live as they do cross.
And no surprise, Amazon following Microsoft higher as well. If you take a look at cloud, it goes Amazon, and then it goes Microsoft, and then you get Google. So you definitely have Microsoft providing some strong numbers there. I do want to point out that we're talking about that 33% growth. In the last quarter, its second quarter, that cloud growth was 31%. So not even beating, but also increasing on a quarter-on-quarter basis.
And I'm so glad you mentioned that, because that was a big concern, that there was going to be this continued deceleration of growth in Azure and other cloud services. The fact that it re-accelerated is certainly a relief for most investors. I talked to Goldman Sachs analyst Kash Rangan, who was saying that anything below a 30% print on that Azure and cloud services revenue would have been concerning. So this kind of removes that, at least that layer of concern.
All right, folks, if you're just joining us, Microsoft soaring in the aftermarket, up about 6% as we speak. This after their third quarter revenue topped estimates. So they are looking for $70.07 billion. The estimate on the street was $68.48 billion. So again, the street liking what the company had to report. We talk about intelligent cloud revenue also coming in better than expected for the third quarter, $26.8 billion versus $25.99 billion. So again, pushing the stock up about 6% here in the aftermarket. That's a big bump to the upside.
Look, it was a great quarter, no question, but I think most investors are going to have questions about what the current quarter looks like and what the outlook looks like.
Yeah.
You know, a weak dollar is certainly a beneficiary. The tech companies are a beneficiary that do business across the world. But we're getting other earnings crossing right now, too.
Well, let's get to Meta. I was just going to point out Microsoft's CapEx spending also going higher, but Meta, Alex, are now crossing the wire.
Yep, taking a look at Meta, its first quarter revenue coming in at $42.31 billion. That's a little bit light when it comes to estimates. Operating income, $17.56 billion. That's much better than estimates. Guys, want to get to the outlook. It sees its second quarter revenue outlook coming in anywhere from $42.5 billion to $45.5 billion, beating estimates.
All right, advertising revenue as a whole, which makes up the lion's share, if not more than that, like 90% of its overall revenue, rose 16% year on year for the quarter. The other revenue higher, growing at a faster rate of 34%, but that's only about $510 million compared to the overall advertising revenue of about $41.4 billion.
All right, stay with Meta, guys. So we're up about 4.7% in terms of the second quarter outlook for revenue, $42.5 billion to $45.5 billion. Quite a range. Estimate is for $44.606 billion. And I should point out that the company, some commentary talking about CapEx. We anticipate our full year 2025 CapEx, including principal payments on finance leases, will be in the range of $64 to $72 billion, increased from our prior outlook of $60 to $65 billion. Again, Meta up about 3.2%.
The company calling out Mark Zuckerberg specifically saying we're making good progress on AI glasses and Meta AI, which now has almost 1 billion monthly active users. We've got a strong start to an important year. Our community continues to grow and our business is performing very well. The business is an advertising business at this point. Obviously, Mark Zuckerberg thinks that Meta AI and the hardware are certainly growth areas, but it's interesting that he calls out AI and the glasses with the 1 billion the monthly active users at the top of the press release.
I think it's interesting also that they're actually slightly increasing that CapEx spending. And just real quickly back to Microsoft, their CapEx expenditures as well, when you factor in all the other things, still at that roughly $21 billion level and going higher here. So that was a big question as to whether we were going to see a material pullback in some of those CapEx forecasts that they had given us in quarters past. At least for right now, it does appear that they are at least sticking by them, and in the case of Meta, increasing
them, which is interesting given that Mandeep Singh of Bloomberg Intelligence has noted that the CapEx over at Meta is growing faster than any other hyperscaler. So they are spending more on AI. And the big question is, when are you going to see that return on investment in its product line? It's rolled out Llama, the large language model in WhatsApp, but it hasn't necessarily done that in the Facebook app or the Instagram app.
Two things to point out. Meta also seeing its full year total expenses a little bit lighter when they did what they did see between 113 billion to 118 billion. It's about $1 billion less on both ends that they thought. I also want to point out too, going back to Microsoft, that the Azure growth that was attributable to AI was about 16 points. It was 12 points in the last quarter. So monetization and being able to profit off of AI is delivering, and that's going to be a key point for these companies.
Microsoft and Meta, certainly the companies we're watching, but not the only ones that are reporting. Robinhood out with numbers right now. Shares bouncing around, down about 1.9%. The company did report net revenue for the first quarter that met the average analyst estimate. Adjusted operating expenses came in above estimates. Adjusted EBITDA coming in just shy of estimates. Shares right now down about 1.5%.
All right, guys, eBay also crossing the Bloomberg terminal. It's actually up about 10% year to date. Let's get to the outlook. It sees second quarter net revenue of $2.59 billion to $2.66 billion. The estimate on the street is $2.6 billion. Reports also the CFO transition and executive leadership changes. So we've got some changes in the C-suite. And again, we're continuing. Let me just take a look at eBay in the aftermarket, folks, just up about 0.5%. So we are definitely seeing some stocks on the move. You got Robinhood moving, Meta, definitely we're seeing some big moves in Microsoft. Sorry, just pulling them up here. Meta's up almost 3% and Microsoft continuing a big bump to the upside, guys. It is up, as I pull it up about 5.6%. All right, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We will see you again, same time, same place tomorrow as we continue to break down earnings. You guys are going to continue on TV. We'll continue on Bloomberg Business Week.
And our coverage continues here on Bloomberg Television, a breakdown of earnings out of two of the biggest companies in the United States, Meta and Microsoft. We start off with Meta with a quarterly beat that did beat analyst estimates here. Advertising stability, that is the main headline, with sales coming in at about $42.3 billion in the first quarter. The increase there, as well as an increase in their CapEx spend, at least for right now, has pleased investors here, staying the course and at the same time still generating revenue off of that ad side of the business. Shweta Khajuria joins us right now, managing director over at Wolfe Research. And Shweta, I do want to start with the ad sales because those were phenomenal again, as they have been in the past, despite a lot of proselytizations that somehow this was all coming to an end. Were you pleased with this report in its totality?
Absolutely. We think so. First of all, thanks for having me. But yeah, absolutely. In terms of Q1, I would say based on what Google had printed and even Snapchat, even though we don't view Snapchat as a big read-through for Meta, and also large agency holding companies from Publicis to Group M, seemed like the first quarter for advertising was going to be largely fine. It was more about the second quarter guide. So the big takeaway here is the second quarter guide came in much better than feared. We were hearing at the high end, investors were expecting up to $44 billion in revenue, and it came in above those expectations. And also on OPEX, it's actually a positive that OPEX guidance was lowered by $1 billion. We actually would not be surprised if they lowered through the year. That's something that this management team has done before. And then on CapEx, that's a modest negative. So we'll be waiting to hear what they have to say, especially after Google reiterated their guide and Amazon is expected to reiterate their full year guide tomorrow. So
when it comes to the ad side of the business, though, too, I thought it was interesting. The average price per ad, that was up as was expected and above analyst estimates. I think it was up 10%. Street was looking for something like 7. Though ad impressions did miss. And I'm wondering, does that matter? I mean, it was up 5 versus 20 year over year. And I think the street was looking for something like 7. Complicating or not?
I don't think it is a huge negative per se, in part because they will have other impressions and other surfaces that will grow. It's going to be a mix of both pricing as well as impression. And pricing, I would say, is kind of an output. But what is remarkable is actually that it is 10% growth in pricing, even when in 2024 we saw pretty elevated pricing level just because they've done so many product changes. So what it tells us is that there is demand for the platform, i.e. there is ROAS for advertisers, otherwise pricing wouldn't be this elevated, would not have grown 10%.
Shweta, how are you thinking about the challenges that Meta faces when it comes to its operations in Europe? Europe accounts for about a quarter of its revenue, at least as of last year. And there have been some violations and there have been some fines, which are fairly manageable for a company like Meta, but repeated violations will start to amplify that cost. And we heard from the company today that it is going to appeal the European Commission's DMA decision on the no ads model, and it expects modifications to its model based on the feedback it's gotten from Europe.
Well, that could potentially create a headwind in terms of an overhang, but I don't think that that will be resolved anytime in the imminent future. It's, if at all, it creates a multiple overhang, but not as much of a numbers overhang, just kind of like what we are seeing here in the US. So it may take longer than people give them credit for in terms of how long it would take for the appeal to go through them to actually go through the entire process. So I don't see that as an imminent risk to numbers, but more of a risk to multiple. The second thing is that I forgot to mention in my prior comment that investors will be looking out for their commentary on impact from tariffs and Temu and Shein and other APAC-based advertisers that could potentially be pulling back. But based on the second quarter guide, it's a surprisingly good guide.
Right. No, that's a really important point, especially given the reliance on those names like Shein, like Temu, Chinese companies in general, accounting for about 11% of revenue for 2024. We also heard from Meta that its outlook does include an increase in expected costs of infrastructure hardware. So there is that vulnerability to hardware costs, including things like its AR and VR hardware sales.
Yeah, absolutely. And then we will also be, just following up on that, investors will be looking out for commentary on headcount growth and where that is going to be coming from versus where they'll expect to see leverage in headcount. And Reality Labs actually could be one of those places where there maybe is greater room for headcount reduction.
So, I mean, based on what we know so far, at least just from the statement, and obviously we still have to wait for the call, how much can we read through? And let's just take the ad business. So I want to make the comparison with some of the other social media companies that have yet to report here. Do you think there's some read through from what we learned today out of Meta into some of those companies as well?
Well, first of all, I mean, we did hear from Google last week. They don't guide to second quarter, and then Snap yesterday. And so what is transpiring here is that Meta is not seeing as much of headwind, even as of second quarter guide, as perhaps some of the other platforms, specifically Snapchat. And that makes sense. They have better auction density. Can we take what they guided to in the second quarter and apply that for some of the other mid-tier platforms, including Pinterest? I don't think so, just because the auction density and the demand for Meta's platform is arguably superior, in addition to them focus more on lower funnel advertising spend versus greater skew towards CPG retail and brand spend for Pinterest. So they still have greater risk than perhaps Meta does. And then the second thing is that while the second quarter guide is good, there is very limited visibility in back half. So if macro turns against them, Meta is not immune, and there's still this risk of downward revisions coming in the back half should consumer spend deteriorate.
All right, good stuff. Shweta, thank you so much for giving us your instant analysis on Meta's results. Shweta Khajuria is managing director over at Wolfe Research. We didn't really discuss the AI angle of it all because Meta is going all in on AI, pledging as much as $65 billion in capex this year. And in fact, it has raised its range to $64 to $72 billion from that previous range of $60 to $65 billion. And a lot of that is because of AI infrastructure and the spending there. The tech giant also announced a new app to compete with ChatGPT as well. So here now to look at this angle is Bloomberg's Ed Ludlow, co-host of Bloomberg Technology. So Ed, clearly this increased capex range that it gave reflects more spending on AI efforts. And the question is, where is that going to show up in terms of the return?
It's right for Remain to point out ad impressions and the relative performance of that, because the next line of the release is really important. The majority of our capital expenditures in 25 will continue to be directed at our core business. I think Meta feels like there is all this emphasis, how many data centers will Meta build? Because data centers train new models. Llama is in its third iteration and fourth iteration. And the question still remains, how does that work in AI translate to value of the ads that they're offering? I expect Mark Zuckerberg to talk about that explicitly on the call.
So when it comes to large language model, Llama, that there's a lot of talk about how it's being rolled out in WhatsApp. But WhatsApp is not something that American consumers are as exposed to or even use as much as international users of Meta. Why is it not being deployed in Facebook Blue or Instagram? Why are they holding back?
Yeah, it's interesting. Like Meta AI is available across the family of apps, right? I use it actually in Instagram quite a lot, or you can use it in WhatsApp. If you are a user of Meta's hardware, which is at this stage largely the Ray-Ban Meta glasses, that did have its own app called Meta View. The area of the market that Meta's not yet capturing is the enterprise in terms of generative AI technology. And so the strategy to that point was like, until this point when they launched the standalone app, was we will offer this wherever you are. That's a thing that you hear all the time across many advertising markets, right? Now I think the focus is saying like, we're a competent AI company. And this goes back to capital expenditures, coming back to the core business. This is the software platform that we are offering right now, and the standalone app answers that.
So, Ed, how important is the hardware side of this business to facilitating progress on AI? I mean, are they or are they intended to be complementary?
I would wager, I'd bet you that on the call, Mark Zuckerberg spends a lot of time talking it up Ray-Ban Metas, but also the future, the smartphone relationship that Facebook or Meta has. So they're left behind. Jump in.
Well, we just only have a little bit of time, but so I mean, you've tested these glasses, right?
I use them every day.
And I know that at some point we're going to see a much broader rollout, but there's been a lot of criticisms or concerns, if you will, about past forays into hardware, whether they actually stick with this, and whether they should be working more with third parties and other things rather than just trying to go it on their own with this.
So look for commentary on Facebook Reality Labs. Until this point, investors did not give Meta a pass on the losses in that unit. Now they're starting to recognize sales of the hardware, and they're saying, all right, we'll look past the losses because you're starting to show us how you make money from the hardware itself. It's gone from being a gimmick to being a top-line driver in some sense.
All right, Ed Ludlow is the co-host of Bloomberg Technology. You see the numbers there on the left of your screen. Meta share is up about 3% here in the after-hours trade. And that's a good thing for the market, or it could potentially be when we get to the cash session tomorrow, given its weighting. But even more important, is the weighting of Microsoft. Those shares right now up 5% here. You did see a beat on both the top and the bottom line. We're still waiting for some modicum of forecasts on the conference call. And a company that has basically said that CapEx number that we gave you back in the day, we're standing by it. Not necessarily raising it, but we're standing by it. So that number did come in just a touch lighter than what the street was looking for. Dan Morgan joins us right now. He's Senior Portfolio Manager over at Synovus Trust. And Dan, I mean, it seems like there's a lot to like in this report. I'm going to start, given that, I'm all like a perpetual pessimist, I'm going to start with the glass half empty scenario. Was there anything in here you didn't like?
Romain, going across, I mean, you mentioned revenue and EPS both beat. They also beat on commercial cloud. They beat on intelligent cloud. Really, you look across the board, productivity and business, they beat. There really isn't any segment data here where I see a miss. Azer was at 33%. Street was looking for 31 to 32. The big number, Romain, is what you've already kind of alluded to, I believe. And I haven't had a chance to check it because I'm in the studio, but we need that guide for fourth quarter on Azer. And the consensus is 29%. Everyone's worried, right, because of what happened with GCP missing. And obviously we roll now into Azer and AWS tomorrow, is that we're starting to see some sort of slowdown in terms of data center spend rates. And so that's the key guide number, that fourth quarter Azer growth rate.
Well, that's what I'm curious about, too, because, I mean, the numbers, at least for the quarter past, held up. But then, like I said, with the warning from Supermicro last night, we just got Confluent earnings just a little while ago today, also all seeming to suggest that maybe there is softness in that space. Of course, Supermicro isn't Microsoft. Confluent isn't Microsoft. Can they weather this storm?
Romain, Microsoft's in a very unique position because, as you know, they have grown their top-line revenue growth 8 consecutive years plus 10%. They are the behemoth in the enterprise software space, right? Next to Oracle. Those are the two really big companies. So I think they're in a much better position than, let's say, other companies like the chip companies, NVIDIA, we're going to talk about a month from now. Other stocks like, PCs, smartphones, where you really get that heavy black cloud surrounding the tariffs, where really Microsoft, other than in data center, maybe component costs in terms of their servers, but, and potential slowdown related to slowdown in GDP in terms of IT spending. But, they're not as subject to all the worries that we have in the tech space. Does that make sense?
Yeah, absolutely.
So, Dan, I look at what's happening right now in after-hours trading. Microsoft higher after beating on almost every metric. Meta higher. And, of course, we had Alphabet, which was very encouraging. Tesla is a whole different story because it's kind of its own, it's got its own drivers, its own factors. What does this mean for the tech sector at large? And here I'm talking about infotech, but also communication services, which is what Meta is included in, regaining their leadership of the market. You have the NASDAQ 100 back at its April 2nd level. So it's erased all of the losses it's had since the Liberation Day announcements. And now that we're at an even level, can they regain their leadership that they had been showing up until the end of last year?
I think, Scarlett, if we reverse back last week and looked at Google's numbers, they missed on GCP. Their numbers were good. Their ad revenue growth was up maybe 8 or 9%, a little bit below what they did the previous quarter. But we look at these numbers, these are blowout numbers. Meta and Microsoft both beat on just about every metric. And I think this kind of sets the tone, guys, because we're going to go in tomorrow, right? We're going to get Apple and Amazon, right? If they also can have really big beats, we can get some good momentum back into the tech space and hopefully get the tech stocks to rebound off of their lows. Because right now, if you look at the S&P Information Technology Benchmark, it's down about 16% off highs, and the S&P is only down 10% off highs that we had in February. So the tech has been held down. But if we can get some more momentum and some more positive reports, Scarlett, and keep that thing going, then we can ride into, NVIDIA in a month, and hopefully we'll get some positive trading back and momentum back in these stocks.
And then when we talk about the impact of tariffs, the legacy from the April 2nd announcements, you have the Meta outlook.
It's
including,
huge.
Yes, I know. The Meta outlook, including the increase in expected cost of infrastructure hardware, of course, increase in cost for its AR, VR hardware as well. But everything else is a little bit more derivative, right? It affects sentiment and affects business spending, and we'll see how that plays out for the companies like Microsoft, for instance. Can we basically say that these companies are more resistant, less vulnerable to the tariff headlines, to the tariff whiplash than others?
You're right, Scarlett, because, you just mentioned component costs. They're talking about Acer with Microsoft, the cost of building the data server centers. And then you mentioned Meta in the same situation. And then you look at Meta, the only concern coming in for this was, would some of these very large Chinese companies cut back, right, on spending in terms of digital spend rates with the likes of, let's say, a Meta or a Google. But I think you make a good point. Now, tomorrow we're going to get two poster childs for tariff impact, right? Apple and Amazon, right? And we can go into detail on how they're being impacted. But they have much far greater impact than you would see out of Microsoft and Meta. And Scarlett and Romaine, tomorrow we're going to hear a lot more about that, right, in terms of those tariffs. So right now they seem almost immune to a certain point, right?
Well, speaking of those tariffs, sorry, I have to interrupt you, Dan. We are getting some breaking news right now. We're now learning, based on Bloomberg reporting, that officials from the European Union are going to actually present some trade proposals to the United States sometime next week. Again, this is according to people familiar with the situation that our Bloomberg reporters have spoken to. We should point out we are seeing a spike in futures here on the back of that headline, so something to keep an eye on. And it gets to this idea, Dan, that while the market, of course, has been weighed down over the last few weeks by concerns about trade and tariffs, if for some reason the market thinks that that threat is removed or at least minimized to some extent here, is there, I guess, an extra boost to this stock? I'm talking on top of whatever own internal fundamental execution they're having that could sort of increase. We could see an increase in multiples as a result.
Well, you're right, Romaine. I mean, let's face reality. If we came out with a headline that said, tariffs removed off the table, these stocks go way, way up. You talk about catalysts. I mean, we've talked about Meta in terms of refining their AI, being able to target better for customers, for their clients, and so forth. You look at Microsoft with things that they're doing in terms of ChatGPT and Azure. I mean, those catalysts are still in place. And, you mentioned before I came on, in terms of Microsoft is still holding on to their CapEx guide, $80 billion for fiscal year 25. So they're going to be continuing to put more money in building this out. So there are still a lot of exciting things. AI is still very resilient. If we could just get this black cloud off the roof, Scarlett and Romaine, these stocks would probably go back to where we were before this whole thing got started.
Okay, Dan, we're in conversation right now with Dan Morgan, Senior Portfolio Manager at Synovus Trust. I'll sit tight for just one second, Dan. I just want to go over the contours of some of what we just learned on this EU thing. Again, based on Bloomberg reporting, Scarlett, the EU is still going to move forward with plans to retaliate over tariffs, but it is ready to present some sort of proposal sometime next week that would effectively lower trade and non-tariff barriers. This would involve boosting European investments in the United States, as well as cooperating on global challenges such as tackling China's steel overcapacity, as well as Europe purchasing more U.S. goods like liquefied natural gas and technologies. We should stress this is according to people familiar with the situation that our Bloomberg reporters have spoken to. But of course, we know this is kind of what the market's been waiting for. Not just, okay, people are lining up for deals, but concrete proposals being put on the table. And again, no disrespect, but not by Vietnam, not by smaller nations, but you want to hear from the biggies. You want to hear from Europe, you want to hear from Canada, Mexico, and obviously China.
Absolutely. And, when we talk about a lot of people hoping for some kind of announcement or the, basic premise of a trade deal coming out this week. They have been maybe disappointed that there hasn't been any concrete details. But this reporting shows that the EU, at least on their end, is very much thinking through very concrete steps that they're going to take. Up until this point, we haven't really seen much evidence that the two sides, the European Union and the U.S., have made progress aimed at, diffusing tensions, diffusing the conflict overall. It was more definitely a state of wait and see for European Union officials, where they had talked about the retaliatory efforts they would take, but they didn't want to actually execute on it until they came up with a better package.
And it gets at this idea, though, too, like how much of that overhang of tariffs was sort of the reason for the drop. Remember, we had a lot of debates about the sell-off, that some of this was tariffs, but some of it was also just about stocks being overvalued to begin with coming into this year, and other economic conditions that are sort of unrelated, or at least not directly related to trade. So if this overhang, or at least there's some signs that there's some progress can be made, does that then provide much more of a floor for this market than maybe what we even had just 3 days
absolutely.
ago?
Because, when the April 2nd Liberation Day tariffs were announced, they were kind of across the board. And it just created this fog of uncertainty. And especially as it became apparent that this was kind of the opening gambit for what would happen next. The idea that all these different countries would come over and negotiate. So now that you have a sense of, okay, there are going to be discussions, Scott Bessent, the Treasury Secretary, will lead the way in those discussions, bilateral discussions with different countries, or in this case, different regions. Then perhaps investors can start to price in a little bit more visibility in terms of how they're going to go value different companies.
Absolutely.
All right, let's bring in Kailey Leinz right now to give us a little more context on these headlines. Kailey, once again, we're just going to repeat the headlines here. The European Union to present new trade proposals to U.S. negotiators next week. What is the state of conversation between the two sides up until this point?
Well, frankly, Scarlett, this administration has not been prioritizing trade conversations with the European Union. Instead, one of the first regions that they've really been dealing with is Asia in an effort to combat China. So Japan, South Korea, India, these are the countries that to this point have been given priority. But Europe seems like it wants to kind of jumpstart its own place in the line here in terms of negotiations by presenting this proposal to the United States, according to sources familiar with the matter. And what's important about this is we understand that this proposal on trade includes both tariff and non-tariff barriers, perhaps in recognition of the kind of language we've heard from administration officials around the issues with Europe specifically. Just earlier this week, when he joined the White House press secretary Caroline Leavitt for a briefing in the morning, Scott Bessent, the Treasury Secretary, actually talked specifically about digital services taxes, for example, the kind of non-tariff barriers that he's referred to as being the real demons that need to be exercised in these trade conversations. So our understanding is inclusive in European proposals here are ideas of lowering some of those non-tariff barriers, also boosting European investments into the U.S. And interestingly as well, Our understanding is they also want to cooperate on tackling China's overcapacity, which Bloomberg's reporting has indicated is a role in these conversations, trying to get other countries aligned with the U.S. on combating.
I am curious, though, about some of these non-tariff barriers. And we should point out, I mean, so we talk about the trade imbalance, which we know mainly the merchandise trade imbalance that Trump focuses on. And we are talking about a region that does import a lot of goods from us, 347 billion euros worth, but of course they export about 500 billion euros worth to us. And on the services side, you also see something similar. It raises the question, though, when it comes to those the ones that aren't directly related to trade, directly related to tariffs, Kailey, are we talking about value-added taxes? Are we talking about an easing of regulation? Because that's been a big bugaboo for Trump, is saying that, look, you know, when you see what the European Commission has been trying to do and cracking down on big tech and some of those other things, he sees that as a trade barrier, too.
Yeah, absolutely. And that gets back to Scott Bessent's point on the digital services tax in particular. And yes, we have seen the value added tax specifically raised multiple times by not just Bessent, but by President as well, others, including the Commerce Secretary Howard Lutnick. And that is where you can see a bit more difficulty in these conversations. It's not just about lowering the rate at which imports are taxed in any of these countries, but also really kind of structurally changing the way in which Europe approaches business in many standpoints. And that really could be where some of the difficulty in these conversations ultimately lie. I would also point out another aspect of this reporting, Romaine, is that Europe, while it has decided to delay for 90 days its proposed retaliation against U.S. tariffs, is going ahead with planning for potential retaliatory measures it would take against the U.S. if indeed tariffs were to be implemented, including a list of goods that could be hit with possible export restrictions. We've also talked about Europe potentially using sectors like big tech to engage in retaliation with the United States if you were actually to see a tightening up of regulation or the way in which those tech companies are able to operate in Europe. That's another avenue in which Europe is thinking it could potentially hit back against the U.S. So this goes well beyond just tariff rates, obviously, speaking to the complication of these negotiations, especially when this administration is trying to have these negotiations bilaterally with so many different trading partners all at the same time and in a window that is rapidly shrinking.
Absolutely. Well said. Bloomberg's Kailey Leinz, thank you so much, giving us some more insight here on the EU to present new trade proposals to U.S. negotiators next week. And of course, be sure to follow Kailey at 5 p.m. on Balance of Power. In the meantime, it's not just Microsoft and Meta that reported. We also had a chip maker, Qualcomm, report earnings too. Qualcomm makes chips that run smartphones, and its outlook was not so great if you were looking for some reason to bid those stocks higher. A fairly tepid revenue prediction for this current quarter, perhaps underscoring concern that tariffs will continue to hurt demand for its products. Let's bring in now from Bloomberg Intelligence, Kushan Sobhani, to give us a little more context here. So, Kushan, what do you see in these forecasts that suggest that the tariffs are really taking a bite out of demand?
I mean, look, the beat in the current quarter and the sort of in-line to slightly low forecast was not really surprising. Most analysts, including us, had called this possibility of this out in our previews, and investors were sort of hoping or expecting this to come. So I think the reaction in the stock is driven by the lack of any incremental or surprisingly positive catalyst. Another thing to remember is going into the next quarter is its seasonal trough. So you don't have any new Apple or Samsung or Android phone launches, and the next biggest event comes in fall with the iPhone launch, where it is expected that Apple will move to its internal model. So there's a lot of already handset-related headwinds facing this company, and the uncertain macro and tariff situation doesn't help.
All right, Kushan Sobhani over at Bloomberg Intelligence. A closer look at Qualcomm. Those shares moving lower in the after-hours trade. And, of course, with Qualcomm's ties to the smartphone sector, a lot of people wondering what you can extrapolate out of today's report and what we might learn out of Apple in about 24 hours' time. With Microsoft and Meta reporting just now, that is the push ahead. A closer look to names like Apple and names like Amazon. In fact, a good chunk of the tech space right now putting their cards on the table, and now investors have to make decisions about whether they want to buy or sell. Sarah Kunst joining us right now. She's managing director over at Cleo Capital. And Sarah, I kind of want to put all this together. We got two big reports today that were relatively encouraging out of Meta and Microsoft. We still have to wait 24 hours to hear what Amazon and Apple have to say. And in between that, you get Qualcomm and a few other companies that maybe give us some insights. Did you come into this earnings season, specifically when it comes to big tech, encouraged or worried?
I mean, I think everybody is worried right now, and it doesn't have much to do with big tech. In terms of tech, it's not a monolith. I always say that. And so for the names that are less exposed to the tariff situation, to some extent even to the macro situation, like the Metas of the world, no, I've been pretty bullish on them because it is unlikely that you're going to stop using, WhatsApp or Instagram just because your 401k is sinking. And so some of those names, I think, are doing very well this earnings season, but it was unlikely they were going to do terrible. Yeah. The other thing to remember is this is an earnings season that doesn't really reflect the reality that we've been living in day to day. This quarter ended, before the tariffs. And so I think that next quarter, you're seeing some of those guidances shift, and that's why. But I think that this earnings season is sort of a litmus test of how people feel about the macro more than they do about some of these specific names.
Well, I am curious, and this is more of a slightly esoteric question. It's less about fundamentals and more about how these companies are managed. I mean, these were juggernauts of companies. They've gone through other cycles, down cycles, economic cycles, and have shown exactly why they're as big as they are. They are popular. They generate a ton of cash, but they're also well managed. And I specifically want to point out Amazon, because there's been a lot of talk about this idea that at least of the companies we're talking about, these four big tech companies, all of them seem to have a pretty decent relationship, if you will, with the White House. Amazon was kind of a case in point yesterday when there was a lot of concerns about what they may or may not have been putting on their website. A call was made, something was sorted out. I may not like that type of politicking or that type of way of running a business, but the fact that he could get the founder on the phone, Bezos, and sort something out. As an investor in these companies, is that a plus for you?
I think it's a question of responding to reality, and what do you do in the moment? The interesting thing about that Amazon piece of news is that rumor was all the way around the world, right, before we had any idea where the truth's pants were. And so I think that it's a great example of maybe that was happening, maybe that was planned, maybe it wasn't, but it hadn't actually gone live everywhere. It was a rumor, and I think being able to have a good relationship, to have an open conversation about reality is a good thing. I think having a good relationship that means that you are bending your reality, bending your business choices to the whim of an administration is probably dangerous long-term for companies, shareholders, and the larger macro economy that company is sitting in. And so in those moments, it's hard to know where reality sits. It seems like the White House believed it was real, whether or not it was, and now it seems that it's not happening, but we don't actually know if that was going to be a thing yet. And so that's that new reality that we're in, where the truth has gotten a lot squishier. And so I think CEOs who can tap dance, that's probably a good thing.
Yeah, and I guess for them, that means you show up to the inauguration as several of those CEOs of the big tech firms
$1 million in hand.
did. That's right. When we look at this earnings season, you said something that I want to pick up on, that it really is a litmus test of how people feel. And I wonder how that affects the management of these big tech companies. How does it affect how they guide their investors? What kind of how aggressive they want to be with their outlook, or how conservative they want to be with their outlook, and especially how they manage the things that they can control, which ultimately comes down to costs and being much more efficient.
I think we saw that, right? Meta said that they're going to spend, I think, $1 billion last full year, maybe out of capital expenditures, which are still like 115 billion or something estimated, still really high. But, there is a sense of this is probably not the time to lean into more spending, particularly because you have to remember every day kind of feels like a year right now in this moment. We're not even 30 days into the 90-day tariff pause, right? So we don't actually know what these tariffs are going to look like. We don't know the impact on the businesses. Nobody does, including the administration, including these other governments, what kind of deals they're going to be striking or not, or if the whole thing just goes away like a bad dream one day. And so because of that, I think you're seeing a lot of caution. Tech hasn't done this as much, but in other industries, you're seeing them flat out say either, hey, we have no guidance, or here's two scenarios, take your pick of which one you think it'll be. We can navigate it either way. And so I think that this is a time of storytelling and sort of soft skills versus here's our expenditures, here's our sales, line goes up.
All right, good stuff. Sarah Kunst is managing director at Cleo Capital. Thank you so much for joining us and sharing us your thoughts on the big tech earnings so far. This is The Close on Bloomberg. The FTC's antitrust case against Meta is heating up as executives from TikTok to Reddit have testified against the social networking giant. The FTC argues Meta has a monopoly in social networking services. Meta disagrees. Joining us now to discuss is Slade Bond. He is chair of public policy and legislative affairs practice at Cuneo, Gilbert and Laduca. Slade, good to speak with you. I mentioned those companies, TikTok, Reddit. You could throw X and Pinterest and Discord in there as well. And this comes to the heart of the idea that Meta wants to define as broad a market as possible, whereas the government is looking at a fairly narrow market. Is that right?
That's exactly right. And first of all, thank you so much for having me. This is a blockbuster case. It is literally years in the making. We've heard about today that there has been just so much uncertainty in the first 100 days of the administration, and antitrust is an example really of a shelter from the storm in terms of market certainty. We have strong bipartisan agreement. We're seeing this in the litigation that this administration thinks that these big tech monopolies, Meta included, have too much power, that they're using that power in a way that harms consumers, harms small businesses, and that ultimately the antitrust laws have something to say about that. Here, there is no question that the Meta antitrust trial has the potential to reshape our economy, I think, for the better in the years ahead. As you mentioned, one of the key fights in this case is really about market definition, which is really critical in antitrust litigation. And the FTC is alleging and showing through white-hot document after white-hot document that Mark Zuckerberg and other senior executives of Meta really viewed Instagram and WhatsApp as its competitive threats. And instead of competing on the merits, they decided it was better to buy than compete. And of course, any firm can engage in acquisitions that don't harm the competitive process. But here, the FTC is showing, I think, persuasively that the purpose of these acquisitions were really to destroy competition.
You mentioned white-hot document after white-hot document. What surprised you the most in those white-hot documents?
Well, I'll say very little at first. You know, I worked on the Hill as the chief counsel of the antitrust subcommittee. We did our own investigation into Meta. I sat in the trial last week, and a lot of these documents were very familiar. And then last week, we saw an email from Mark Zuckerberg where he openly had this thought experiment with his senior executive team about self-breaking up, about cracking the company open. And one thing that caught my attention is that he said, basically, this is good. It's something that in the history of corporations, companies that have divested assets that either are underperforming or perhaps were distracting from the mission of the company was inherently a good thing. And it seemed like a good faith question to his team. Now, ultimately, Meta did not do that. Instead, they've tried to build this family of apps around its core monopoly in an effort to protect that monopoly and to make it difficult or at least confusing to regulators where to draw the line. But during our investigation, one thing that stood out to me is we spoke with senior executives at the company, whistleblowers, and they told us that this is not difficult to do. It's not like, taking the Empire State Building apart. It's something that companies do all the time.
I am curious, though, Slade. I mean, when we talk about what the potential outcome of this case can be, I mean, it's not just about, of course, I don't know if you call it a smoking gun, but obviously the idea of sort of, that they kind of knew where the competition was coming from and realized they needed to snuff it out. But there's also a big debate, and it's not just academic, as to exactly what Meta is in terms of how you define it as a company, or at least in terms of what sort of industry it really encompasses. Because if it is a direct competitor to just, Snap or, one of those types of platforms, that's a totally different argument than if you view it as a competitor to, Apple or Alphabet.
Yeah, I mean, the truth is that you can take your bike or take a car to your next meeting, but these are not companies that are competing within the same product market. And here, Judge Boasberg, who's the presiding judge in the case, has already shown that he's very skeptical of the argument that Meta is setting forth, that it competes with basically everything from YouTube and TikTok to sleep for consumer attention. And the story that Meta is trying to tell, and Mark told us in over 10 hours of testimony last week, is that, Meta, Facebook, Instagram are discovery engines, and people go to the platform, maybe interact, and then share elsewhere. But the truth is that this experience is different, that, people use these platforms in different ways. I would not go to TikTok to see photos of my friend's wedding. I would not post, pictures of my child's graduation on LinkedIn, probably. And the point is that the market realities at this case are pretty clear, that these are all sub-markets, something that antitrust also cares about. So in terms of this question about, what is the broader market? Can social media include YouTube, TikTok, other vertical video content? I think we should listen to the executives of those companies. So executives from YouTube and TikTok have said they don't view themselves as being in the same product market. Mark Zuckerberg's most senior data scientist wrote a really compelling memo at the end of 2018 called the End States Memo. And it said that they don't view it that way either.
All right, Slade, really great stuff. We have to leave it there, though. We have to get you back on here because not only this case, but of course, what's been happening with the Alphabet case as well. The great Slade Bond, Chair of Public Policy and Legislative Affairs Practice over at Cuneo, Gilbert, and Laduca. We'll be back in a moment. This is The Close on Bloomberg. All right, we just got earnings out of the second and fifth highest weighted companies in the S&P 500, and in about 24 hours time, we're going to get the number one weighting in that index, and it's Apple. Joining us right now to talk a little bit more about this is Daniel Newman, CEO of the Futurum Group. And Daniel, I know expectations are always high for Apple. We're looking at about 4% revenue growth based on analyst expectations here, and iPhone revenue of about $46 billion. Now, we just got some earnings out of Qualcomm, which of course supplies a lot of original equipment manufacturers, including Apple. Anything we can extrapolate from today's results into what we might learn tomorrow?
Yeah, hey, good afternoon, Romain. Apple is going to be a big moment because everyone wants to understand what those macro uncertainties and what the various headwinds might mean. We're going to be looking a lot for the guide because obviously the tariffs hadn't kicked in necessarily during that period of time. But what Qualcomm showed me today that I think Apple investors can feel pretty positive about is that ultra high-end premium smartphone tier demand really seems to be in a good place. And that means the consumer at that level is continuing to invest, feels strongly and committed to making those purchases. And I think for a lot of people, that's the initial worry is with the uncertainty, with the tariffs, with potential recession and consumer pullback, what does that mean for iPhones? And what it looked like from what Qualcomm said was, we still feel pretty good. Remember, Qualcomm even raised its guide and felt confident in putting its numbers forward for next quarter as well.
Well, I mean, in fairness, of course, they do have a bigger business besides Apple. And there has been a lot of concerns about the Apple refresh cycle, given that it is pretty much the premium product out there in the smartphone space. So if you don't have, $6,000 to $1,000+ to spend on a phone, you might look for a different model. Is that a concern of all, or do you think Apple just has enough momentum at this stage where they'll find a way to recoup that?
Yeah, you're absolutely right. To be very clear, Qualcomm is not providing most of the chips to Apple. It's mostly the technology at this point. But their competition with the Samsung devices, the high-end premium phones that are paid and bought for in China, Xiaomi and Oppo, those compete. I definitely think where you're going to see more risk is down the ladder, the lower end, mid end devices. Those are where people pull back immediately. They may let their device go a little bit longer. The demand on Apple has, over periods of time, as we've seen ups and downs in the economy, has remained pretty resilient. The Apple ecosystem, the Apple device, I think it's more margin pressure. It's going to be moving to India. It's going to be the potential of the tariffs. And during this period of uncertainty, that's where I think people are going to be paying a lot more attention. I just think we've been in some level of a recessionary environment for more time than we really want to admit. But I think the high-end buyer has kept buying, and we're so committed to our devices. It's such an inherent part of our lives.
Okay, let's move on to Amazon. What do you think is going to be the bigger driver here for the share price and for investors to either do something with their holding and add to it or maybe trim it? Is it going to be the exposure to tariffs through the goods that it sells and through the Chinese sellers who make up that big part of the third-party business? Or is it going to be the cloud business, AWS, and the continued deceleration, even as we saw Microsoft actually reaccelerate growth in Azure and its cloud services?
Yeah, it was a great day for the cloud providers today. We got reaffirmations on some serious CapEx investments from Microsoft and also an up from Meta. On the AWS side, clearly they're going to need to follow suit. If they're not at or above their number, right? We saw Alphabet at their number. Microsoft really blew it away with strong demand for AI. I think that will be a big concern. Because remember, AWS is such a massive contributor to the operating margins at Amazon that if that number starts to wane, the other concerns become even bigger. We saw the drama this week, Scarlett, around the tariff pricing and what Amazon is going to do and how it's going to handle some of its lower end business. I think we've seen this kind of settling, but what we haven't seen is enough economic data yet on whether or not consumers really slow down. Does Shein raising prices by 150% on, a $2 item really stop consumers from buying, or the volume they're going to buy? But I think it's going to start with cloud. It's going to start with its reaffirmation of its CapEx that it's still committed to building out, because this is where the company makes its money. But having said that, nobody wants to see the commerce business fall. Also, though, we're going to be watching Amazon's ads number. That's become a $40+ billion business for them. And that's been a juggernaut.